Donald Trump calls it patriotism. Xi Jinping calls it opportunity. This week, Kenya, Argentina, and even Saudi Arabia canceled billions in dollar loans, rewriting them in Chinese yuan. Bloomberg confirms central banks now hold more gold than U.S. Treasuries for the first time in history. And the WTO just warned global trade growth will crash to 0.5% in 2026. What started as Trump's tariff war is turning into something far bigger, a currency rebellion that could decide which superpower writes the next century's price tag. On trading floors in Nairobi, São Paulo, and New York, currencies are moving faster than algorithms can price them. Traders whisper about a memo from Beijing, one line buried in translation. Yuan facilities to replace dollar exposures in bilateral lending effective immediately. By morning, Kenya's treasury confirms what everyone feared. The dollar loan that financed its railway is gone, converted into yuan. According to Reuters data released in September 2025, that single decision will save Nairobi roughly $215 million per year in interest. A small act with large intent. Proof that dollar dominance can be unwound by spreadsheet. Hours later, Bloomberg reports Argentina renewed its currency swap agreement with China, adding another $5 billion in yuan credit to replace its shrinking dollar reserves. The move stabilizes imports for 90 days, but the IMF warns that such reliance may tilt Argentina's balance of payments toward Beijing's policy orbit. The headline vanishes within minutes, replaced by charts showing the dollar index falling to its weakest level since 1989. By October, the WTO cuts its forecast for global trade growth in 2026 to just 0.5%, barely half a heartbeat for the world economy. The reason: tariffs, export controls, and financing costs tied to the world's most overborrowed currency. The U.S. 10-year Treasury yield sits above 4.2%. The Chinese equivalent drifts near 1.9. That 2-point gap is a neon arrow pointing at a cheaper lender. The logic becomes arithmetic. Countries that refinance in yuan instead of dollars cut debt service roughly in half. Kenya's example proves it. Zambia follows with a $750 million conversion in August. Ghana structures a dual currency tranche, 60% yuan, 40% cedi, to avoid exchange rate shocks. None of these governments call it de-dollarization. They call it survival. Yet every switch erodes a pillar of the eurodollar system, those $13 trillion in offshore dollars circulating beyond U.S. jurisdiction. For decades, they supplied liquidity that made Washington's deficits tolerable. Now each converted bond tightens the loop. Bloomberg Intelligence notes that central bank gold holdings exceeded Treasury holdings for the first time in 2025. $4.22 trillion in bullion versus $3.8 trillion in U.S. debt. The signal is unmistakable. Confidence has moved to metal. Donald Trump's renewed tariff campaign accelerates the flight. The Financial Times cites internal WTO modeling showing American imports could contract 6% in 2026. Exports down 1%. U.S. farmers already feel it. In an October interview, a soybean producer in Iowa told the Wall Street Journal, "We're in a tariff war with everyone. I can grow it, but who's buying?" His question sits heavier than his crop yield. Meanwhile, China's Ministry of Commerce reports a record $1 trillion trade surplus for 2025. That surplus supplies the very yuan others now borrow. The irony is mathematical. The more America taxes imports, the more liquidity Beijing gains to lend. Across Africa, swap lines bloom like new embassies. Nigeria signs a 15 billion yuan facility in July. Ethiopia negotiates one next. Each agreement promises stability but embeds policy leverage, access in exchange for alignment. Critics warn of dependency. Supporters call it diversification. Both are partly correct. Europe isn't immune. Hungary issues its first sovereign panda bond, a 2 billion yuan offering underwritten in Shanghai. The yield? 1.7%. The timing? Just after Trump's tariff extension on European auto exports. Coincidence or calculation? Interpretations differ. In Washington, Treasury Secretary Scott Bessent insists deficits remain sustainable. Yet Treasury data released in September show federal borrowing at $1.8 trillion for 2025, up 22% year on year. Interest payments alone surpass $980 billion, more than the Defense Department budget. Every additional bond auction demands buyers, but foreign demand is thinning. Japan trimmed holdings by $112 billion since January. China sold another $48 billion. The void is filled by the Federal Reserve itself. Let's stop for a second. Because what just happened wasn't supposed to happen, not this fast. For decades, analysts argued that dollar dominance could erode only through catastrophe, a war, a default, or hyperinflation. None occurred. Instead, the shift is bureaucratic term sheets rewritten, yield spreads recalculated, local treasuries chasing cheaper credit. It's evolution disguised as paperwork. Now the question turns inward. If the dollar weakens gradually, does that make America safer or more exposed? The IMF's October 2025 Global Financial Stability Report notes that a 1% increase in U.S. long-term rates erodes $2 trillion in global bond value. The same report lists policy unpredictability as the top risk factor for reserve currency confidence. Policy here means tariffs. On Wall Street, foreign exchange desks track something new. The CNY Funded Loan Index yields on sovereign debt denominated in yuan. By mid-2025, it reached $280 billion outstanding, up 60% year over year. Bloomberg calls it the shadow twin of the euro dollar. Meanwhile, India straddles both worlds. Its exporters pay rising duties in U.S. markets while settling half their Chinese imports in yuan. Reuters reported in August that India's share of yuan-denominated trade settlements doubled in 12 months to 7%. That's modest but symbolic, a regional hedge against volatility. South Korea signs a swap renewal with the People's Bank of China worth $60 billion, citing need for liquidity flexibility. The phrase masks anxiety. Korean chipmakers depend on U.S. technology licenses, yet finance operations through Chinese credit. Its monetary bipolarity institutionalized. In Latin America, Brazil's central bank is testing yuan clearing through Banco do Brasil's Shanghai branch. Mexico's deputy governor tells Bloomberg, "Dollar liquidity is tightening faster than trade volumes. A decade ago, that sentence would have been heresy." Back in Washington, the administration frames the tariffs as a patriotic defense. Officials highlight GDP growth at 3.8% and a productivity surge unlike anything since the 1990s. Yet, the Bureau of Economic Analysis quietly shows manufacturing output falling 2.3% year over year. Retail sales growth, 6% nominal, is mostly inflation. Productivity rises because employment lags. Every metric contains its own contradiction. The World Bank warns of feedback loops between trade contraction and currency diversification. Translation: the more tariffs bite, the more countries flee the dollar. Commodity markets echo the shift. Gold breaches $4,000 an ounce. Bitcoin trades at $124,000, up 78% since January. Bloomberg attributes both rallies to hedging against fiscal instability. In practical terms, they're votes of no confidence. Even oil is settling differently. The Shanghai Petro Exchange records 22% of global crude contracts in yuan by the third quarter of 2025. Saudi Aramco's partial pricing shift after its China deal made that possible. For decades, petrodollar defined energy trade. Now petro-yuan enters economic textbooks. The geopolitical consequence is quieter but deeper. Nations borrowing in yuan find themselves tied to Chinese development banks, Chinese contractors, Chinese arbitration. Beijing doesn't need to dictate terms. The contracts do. U.S. policymakers counter with rhetoric. America's financial system remains the most transparent in the world, Treasury officials tell the Financial Times. The statement is true and irrelevant. Transparency is useless if credit costs twice as much. At home, deficits demand financing. The Treasury auctions longer maturities to attract pension funds, but, yields climb. Each percentage point higher adds roughly $300 billion to annual interest expense by 2026. The mathematics of empire are simple. When your cost of money doubles, power halves. China's cost remains lower. Its state banks lend abroad at subsidized rates, backed by that $1 trillion trade surplus. When Ghana or Kenya refinances, Beijing gains both yield and influence. The IMF calls this a redistribution of financial intermediation. History may call it something shorter replacement. Currency markets react mechanically. The DXY slips below 98 for the first time in 3 years. Eurodollar futures price in 3 rate cuts, signaling belief that the Fed will blink first. Corporate America braces. Walmart reports shrinking import margins. Apple delays a product launch due to tariff costs. Boeing petitions for export waivers. None of this reads as collapse. It reads as compression. The deficit narrows statistically but deepens structurally. Unemployment edges toward 5.2%. Inflation stays above 3%. The combination is stagflation with branding. Farmers plead for relief. "I can grow it if you find me a buyer," an Iowa voice says again on WSJ Video. Trump visits Des Moines, promises new subsidies. Congress approves $80 billion in aid. Financing comes from fresh debt, issued in dollars, bought domestically, monetized indirectly. The same cycle that nations abroad are fleeing repeats at home. Canada's Prime Minister Mark Carney tells the Financial Post, global monetary fragmentation is the most significant risk since 2008. He argues for new frameworks linking Western and Asian capital flows. His words land politely, then disappear beneath U.S. election coverage. By January 2026, emerging market reserves in Yuan will reach 7.8% of the global total. Triple the share in 2020. IMF data confirm it quietly. No declarations, no summits, just accounting entries shifting east. And beneath all of it, a question grows louder. What anchors a currency's power? The economy behind it, or the belief in its permanence? When the dollar was tied to gold, faith had metal. When it floated, faith had momentum. Now momentum leaks. If America's tariffs and deficits define the next decade, its currency may keep shrinking without collapsing, draining influence drip by drip. The world's trade lanes are already rerouted. The spreadsheets have already been rewritten. A trader in London watches screens blink between USD and CNY quotes, shrugs, and says to no one, "We just changed the world's default." The data confirms it. But the market hasn't decided whether to cheer or panic. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.